Our next guest helps manage $10 billion in UK gilts. Mike Amey is Managing Director and UK Fixed Income Portfolio Manager at Pimco. He joins us now in the studio. Thank you so much, Mike, for joining us. In terms of what we're expecting today from the Bank of England, are you looking at any rhetoric that actually they're still ready to fight inflation, or is that going to take a backseat for now?
So I think the focus on the Bank of England will shift over the year. And I think if you look at last year, the challenges were avoiding, consistently weak growth and avoiding the debt deflation trap. And I think we have now moved into a period in which the bank will focus much more on inflation. Whether we see that in today's decision or not, personally I think it's a pretty close call. But I certainly think the shift of the debate is moving to inflation and away from sustaining growth, yeah.
And so in terms of what that means for gilts versus bonds versus treasuries, how do you see that playing out?
So gilts, 10-year gilts are about let's call it 380, 385, which doesn't actually offer that much over 10-year treasuries at 360, 365, and 10-year bonds, kind of 25 lower than that. I think personally that's a pretty small excess yield, given the higher inflation risks in the UK. And given the risk that the Bank of England, gets the central bank ball rolling and is the first to raise rates, so I think gilts will underperform Europe and the US. Yeah.
Mike, in terms of what we're seeing between the 10 and the 30-year gilt, is that spread going to continue to narrow?
So the 30-year gilt has a lot of support around about 4.5, just as a result of the pension fund demand. Although we have seen a lot of supply recently, so the supply has been there to meet that demand. I suspect if yields continue to go up, then the 30-year will probably outperform the 10s, yeah.
Mike, in terms of what you're telling me, of course, the focus now will be on inflation. Does that mean that there's a risk that the Bank of England will raise rates in the next couple of months before the economy is actually ready for it?
Yeah, so as I say, the Bank of England, the probability the market has on the Bank of England raise rate stays about 20%, and is priced for a 25 basis point hike by May. I think, if anything, the market's being a little bit complacent on that. The Bank of England, if you go back over the last 10 or 15 years, has had a habit of surprising the markets. And I think, we may well be in one of those periods whereby, the uncertainty premium on the Bank of England should go up. Yields, therefore, should potentially go up. And we should, not be quite so complacent.
So, Mike, you're expecting an interest rate rise in the next couple of months. What happens after that?
I think once they start, I think it would be fairly surprising if they just did one. So that's really the key debate they've got to have is do they want to start now or do they want to start later on in the year? And that's going to be the crux of the matter today. So once they start, I suspect they'll do probably 25 a quarter from the point at which they begin.
But are you fearful that actually if they do rise and they rise quicker than some markets are expecting and we have the austerity measures, it will push the UK into a double-dip recession? Absolutely.
So that's the key debate they've got to have, is when they want to start and how confident they want to be that the recovery is sufficiently robust. The Q4 GDP numbers have obviously put a question mark under that, but most of the other data would support the fact that growth is holding up okay. So I think really the question is one of timing. And when they start to raise rates rather than, if they start to raise rates.
And Mike, just to make sure that I get it 100% correctly, when do you actually expect them to start, sooner rather than later?
So I think they'll certainly start by May, and I suspect they'll probably do 25 a quarter for the quarters thereafter, out into next year, yeah.
All right, Mike, thank you so much. Mike Amey there from Pimco.